Guys, so now let's discuss assignment sales. The fact that we're going to get charged HST now, for sure. Now, the reason I say that is because assignment sales in the past, they were charged HST all depending on your intention. And let me explain. So changes. An assignment sale is this, if you buy a pre-construction property that's going to be completed in 2025, obviously there's a few years in between you buying that unit from the builder and it actually being completed. So what you're able to do, and some builders allow you to do this, is assign that contract to another buyer. And this is kind of common in the Toronto real estate market. Sometimes there are people who are buying pre-construction units with the intention of selling this contract to another buyer before the property is completed. Sometimes people are buying pre-construction units with the intention of moving in, but things happen in that 4 or 5 year period while they wait for the unit to be completed, and they need to assign the property to another buyer because of circumstances. So I think that's really the differentiating piece here. The intention, did you buy this in order to flip it, or did you buy this in order to move into it, but something happened and then you need to sell it? So I've helped people in both scenarios, and the new change here where the government is looking to charge tax any time that you sell an assignment, whether you have intention or not, is to really limit those flippers, right? They're looking at that as speculative trading in our marketplace. Just to recap, an assignment sale is when you buy a property from a builder, pre-construction, it's not completed yet, you don't have full title of the property yet, you just have a contract that says you're going to buy a unit, and you're subsequently selling that contract to a new buyer. Okay, when you sell an assignment to a new buyer, you are the assignor, and the buyer that's buying that assignment contract from you is the assignee. This is already implemented, and now what the government is doing is they're charging you HST whenever you do an assignment sale with pre-construction purchases. And not only are they charging you 13% HST from the original builder, but actually you get charged 13% tax when the new buyer purchases that contract from the assignor or from the original buyer. So there's a potential of 26% tax on one assignment sale, one pre-construction assignment sale, and that's huge, right? Because in the past you could possibly avoid paying HST at all. Not to mention that you, as the original buyer, may be employing a real estate agent to advertise and market this for you. So you're paying commissions to that agent up to 5% possibly, and there could be a few $1,000s of fees that you can be paying to the builder in order for them to actually process the assignment. So there's a lot of fees involved now, and you need to be really conscious of these changes, because your appreciation from when you bought that from the original builder up until now has to exceed that percentage. You need to make sure that you're capturing and being able to pay off all of those fees and still making profit for this to even make sense anymore. Assignment sales are still going to happen in our marketplace. People are just going to have to adjust to these new rules. We'll also talk about the brand new tax credit. It's a multi-generational home tax credit. This is for families who are looking to add a second unit to their home. Caveat here is that it needs to be for a relative, an adult with a disability, or an elderly relative. You must be making this unit towards them. In this case, you actually do get a credit of up to 15% of $50,000 in savings. That is actually resulting in about $7,500 in savings, which is amazing. I know that it could cost up to $50,000 or possibly even more to build a new unit, whether it be in your basement, or now many cities are allowing garden suites in the backyard. It could be pretty expensive. So for you to be able to collect $7,500 back, I mean, that's like flooring and painting for the whole in the unit, maybe, and that's huge. I think that that's really great. You got to really read the rules and see if this is something that could be eligible for you. But if you're in that type of situation, you're looking at a unit to house a relative, then you can take advantage of this brand new tax, the multi-generational home tax credit. There is another brand new tax incentive. It's called the tax-free first home savings account. This is different from the home buyer's account, which uses RRSP funds for your first down payment. This is a brand new account which you can open up. You can only use it once in a lifetime, and you can actually save up to $40,000. You can be saving $8,000 per year into this new account, up to the $40,000 like I mentioned. Anytime that you add money into this account, it actually lowers your taxable income. So if you made $100,000 in the year, you put in $8,000 into the savings account. Now you're going to be down to $92,000 in taxable income, which could actually save you some money on your tax return. Maybe you get a bigger tax return. Really all depends on your numbers, but it does play like an RRSP in the sense that it does reduce your taxable income, which is incredible. And if you want to do research on the home buyer's plan, that also does exist. you have the ability to use up to $35,000 of registered retirement savings plan and put it towards your down payment as well. If I'm not mistaken, you can actually combine both, and some people might be in that position where they're saving into their tax-free home buyer's account, and they also may have some incentives from their work where their work is putting money towards their RRSP, and so you might be able to kind of juggle both and use a little bit more down payment using these two programs for your first home purchase. So now let's talk about the doubling of some existing tax incentives that are already in place. The first one being the first time home buyer tax credit. In the past, we're actually able to take up to 15% of $5,000 of down payment money. Here in the GTA where we operate, it's very uncommon to have less than $5,000 in deposit or down payment money. Typically, you're putting a lot more because of home prices here in Ontario. So you're always putting up at least $5,000. And the old rule was that you would get a credit of up to 15% of that $5,000 down payment, which resulted in about $750. That is doubling now, so you're actually getting 15% of $10,000 of down payment money, which results in about $1,500. That's great because, you know, some people were getting obviously their $750. Now you're going to get $1,500 whenever you buy for your first property. So talk to your accountant about that. Make sure that if you bought a property in this calendar year, you should definitely be requesting this tax credit because it's free money. The other one is home accessibility expense tax credit. If you are adding accessibility features to your property, actually are now able to claim up to $20,000 of eligible expenses. Both of these are available in 2022, so don't forget to take advantage of those if you are able to. Last one, guys, is the first time home buyer incentive. So this program wasn't super popular. It was something that Trudeau implemented a few years back. It's kind of like a profit share program where the government is giving you 5% down payment, helping you with your first purchase. So for example, if you only had 5% down payment available in cash for your purchase, the government was actually giving you 5% as well. So you would be now going up to 10% down payment. This is for a resale property, and effectively that would actually improve your approval. That actually reduces your monthly expenses. But keep in mind that the government kind of owns 5% of your house. So in the future, if you were to sell your property, they're actually going to capture a 5% profit, right? And if you were to have a loss, for example, you sold your property and you lost money on that sale, they would lose also on that 5% of their property. So it is a profit sharing program, and they are there whether you win or lose. But obviously they're doing this, why? Because they think that the properties are gonna go up in value. Obviously they wouldn't be just throwing money away if we're in a declining market. And if you're buying a new construction property, they're actually even able to give you up to 10%. So not a lot of people were taking advantage of this. Actually, the first version of this really neglected the market of Ontario because I think qualifying or the maximum purchase price was like $540,000. And obviously, if you're buying a property as a first-time home buyer, had some clients that have taken advantage of this program. It actually did improve their approval. It got them into maybe a more expensive property, and it is now also helping them on the mortgage side every single month. I just let them know, look, I mean, obviously the government now it's giving you this 5%. You have the ability of paying back that 5% at any time. So it's kind of like an open loan, but you do have to kind of pay it back within 25 years. If you live in that property for 25 years, which a lot of people don't on their first purchase, you got to pay it back before then, or you pay it at the time of sale, or you can just pay it back whenever you can. So if you have some extra money and you're able to pay up that 5%, you can clear it in year 1 if you want, or in year 2 if you want. Another part of the 2022 federal budget was the banning foreign buying for a 2-year period. Prior to this, they already had a 15% tax on anybody buying property here in Canada that doesn't have Canadian citizenship or permanent residence, or isn't in school, possibly get their permanent residence in the future. There's exemptions there. They were charging 15% tax, but now they're completely eliminating the ability to buy property if you're a foreigner here in Canada. Just so you know, this is more of a BC problem. Wasn't really a big Ontario issue. There was a lot of buying happening in luxury markets of BC. People were buying homes in the millions of dollars. They weren't even moving in. They were almost sheltering their money there. It was appreciating. There was no taxes charged on foreign buying there. And now I think they have like an empty home tax, but you know, the damage has been done. They've already bought their property. They've already made money. It's actually already worked out pretty well for them. But we did look at some data here in Ontario where we saw that there's actually about, at least before the pandemic, about 200 foreign purchases on a monthly basis. So it wasn't really that much. And during the pandemic, that was cut in half to about 100. So here in Ontario, really that buying wasn't really a huge thing. So I really don't think it's going to impact our marketplace here locally. But I mean, look, if you're watching this video and you're looking to buy property here in Ontario, or in Canada, you're not able to for at least 2 years. And if you really did want to do that in the future, hopefully you got a family member over here, or hopefully you have an intention of moving over here and getting citizenship or permanent residence. That's the only way you're going to be able to either purchase or avoid any tax related to that purchase. So guys, we're always on top of our real estate market here in Ontario and Canada. We're on the up and up on any new changes, whether it be a federal budget change, whether it be interest rate change or shifts in our marketplace. We're reporting to you guys. Again, we're feet on the ground, meaning we have active buyers, we have active sellers as well. So we know this information even before the news does. So if you really want to be on top of what's going on, you need to subscribe to us here on YouTube and follow us on our other social channels so you're not missing out. Talk to you guys soon.